Trump is planning new tariffs and markets are at a record high. Just on Tuesday alone, 70% of inflows moved into 7 tech stocks. And that's retail money. That's a record number according to JP Morgan. And in this video, we want to explore what actually happens if that uncertainty around tariffs, an uncertain economic situation, meets an overheated market. Could it lead to a major trend reversal, which might impact your investments as well, your money, your savings? Let's go. Hello, my name is Ben and I'm the founder of MCO Global. On this channel, we take a look at the markets from an Elliott Wave point of view. Elliott Wave perspective, it's a market analysis method, but it's sentiment based. So we analyze market sentiment. This gives us a very good idea of turning points in the market. And therefore, when I read news about overheated market sentiment, I'm always watching, I'm always on high alert because it matches my Elliott Wave analysis. So what I want to do in this video, we want to take a look at the S&P 500, Dow Jones and Bitcoin long term. I want to give you a broad market overview to align that with the view that Bloomberg have as well, that the market sentiment is very, very high, or at least JP Morgan have that perspective. So kind of they confirm my Elliott Wave analysis. We want to do that. And we also want to talk a little bit about what impact could the tariffs have that Trump is imposing. So this is an article, it's a premium article from Bloomberg. What I found interesting, I just will cite from this article. What they highlighted is that retail investors poured $3 billion into stocks on Monday. But there are 2 things I really want to show you. This one here is the retail sentiment score reached new highs. So that's from JP Morgan. And you can see that it reached a record high. And we all know that retail traders and investors are usually on the wrong side, right? So whenever I see that a retail sentiment score reached a new high, it means greed is high. People want to make money. People who haven't invested yet into Netflix, Meta, and so on, they try to do that now. Whereas my Elliott Wave patterns that I'm tracking these charts separately, well, they show they are pretty much running. These rallies are on their last legs. And yeah, they highlighted here, not surprisingly, about 70% inflows went to 7 stocks, the large 7, like I think Nvidia as well. It was retail who bought that price drop that came with the DeepSeek news. So that's very interesting because I'm looking at the charts just purely from a sentiment-based point of view. We use a different market analysis method than JP Morgan, of course, and I will share with you those charts in a minute. Not the tech stocks, but the S&P 500, JP Morgan's, not JP Morgan, the Dow Jones and the Bitcoin chart. So that's one thing to keep in mind. Another thing I wanted to mention, so we've got the sentiment, we've got the overheated sentiment. The other situation that we're currently dealing with in financial markets, in the economy, in the world, are Trump's tariffs. So Trump is implementing tariffs, 25% additional tariff on imports from Canada, Mexico, and 10% additional tariff on imports from China. The US import a lot from China, Now this could trigger potentially a trade war, and China is reacting already. So what are the risks when there are tariffs? There are several risks. Now, what is Trump trying to do? Let me show you one graph because this is what it comes down to. This is the US balance of trade. You see that's coming from the Bureau of Economic Analysis. It shows this trade deficit. What does that mean? It basically means that the US, they are spending a lot of money to import goods. Why do they do that? Because US customers, US citizens, they love to buy cheap stuff. There's a lot of cheap stuff that comes from China, okay, and other countries, but also a lot from China. What Trump doesn't like is that a lot of jobs are moving abroad. So less jobs for production in the US, because what do the businesses do? Well, US customers want to buy stuff, okay, so as a business, you move your production to cheaper countries, right, where you can produce cheap. So they do that, and Trump wants to move them back, ideally. How is he doing that? Well, by imposing tariffs. Why? Because if now products are produced abroad, the US citizens have to pay more for it. Now they're not going to do that, possibly, not to the same degree. That means those customers might avoid buying these products. So less sales for these businesses, that means they might move them back into the US. It's just one, it's just one consequence. Now that could be positive, that could be negative. There are pros and cons for sure. I don't really want to talk about are tariffs a good thing or a bad thing, but I just want to make sure it's clear what kind of consequences there could be. Now, while it might be a noble idea to move jobs back into the US and bring businesses back or factories back, please note that this can take years. I mean, you can't just switch a button. I mean, I've worked more than 15 years in manufacturing industries. I've worked in the automotive industry, machine building industries, optics, different industries. Now, you can't just set up a production facility. It takes years. You have to plan it, supply chain, you have to find people, you have to implement processes. It takes time. So what does that mean? Well, it means that there will be that period where people either won't buy those products or they have to pay more for it. That means inflation goes up. That might again affect interest rates, the Fed interest rate decisions. It's just a lot of stuff in the mix here. In addition to that, there might be retaliations by other countries, could start a trade war. So there is a lot of uncertainty. Now that uncertainty is like a melting pot, and that meets overheated market sentiment that we will now take a look at on the S&P 500 chart. And I will not take a look at the chart on a micro level. We do our short-term analysis in our stock service, S&P 500 service. We've got a lot of customers who booked that package. If you're interested in that, you can follow the link in the description. I provide daily video updates about the S&P 500. It's a lot of work, but there's no point doing that here because these videos are really here to last. I want this content on this channel to be long-lasting. You can come back in a week and watch it. You can come back in a month and watch it. It will still be up to date. But there is a link in the description for short-term updates. Now, why is this important here? And why is this overheated? Well, you see it, right? You see it. This is the long-term chart of the S&P 500. You see that it's not the beginning, but this is the data I've got, and I've got an initial wave 1. I've got a wave 2. This is very noteworthy. A wave 1 and a wave 2. That's end of the roaring 20s, crash, yeah. Yeah, that was the end of the roaring 20s. We had a significant economic downturn. It had major consequences for society and it affected the world. We then had World War II. After this 1-2 setup, we had a third wave. Now, interestingly, this wave 2, which bottomed in 1942, by the way, very interesting. A lot of people say in wars, markets can't go up. Well, you see, in 1942, the market already bottomed, right? Markets are always forward-looking. So that's always something people don't understand. A lot of people just always ask, does a war have to end for the market to go up? No, it's just not like that. But anyway, we had a long third wave into the 2000s. Now, what happened? Tech bubble burst. We talked about MicroStrategy in yesterday's video, Strategy B, they are now called, and they also collected a lot of money during the tech bubble. But what happened then was this large correction in a wave 4. Now, this wave 2 and this wave 4, they belong together. Similar duration, at least in proportion, it looks good. Now, what I propose is, after this fifth wave, which is nearly done, it's already overextended, we should get this wave 4, which will match the wave 2 that happened after 1929. And this could last 10 years. People might call me crazy. Why 10 years? It's crazy. Well, we already had a 10-year correction, which was this one, also a wave 4, 9 years that was, between 2000 and 2009. I believe I will not see in my lifetime another crash or correction like this or bear market. It will have huge societal consequences. It's due anyway. And if it doesn't happen now when I think it's going to happen, then it will happen in a few years. It is due. It has to happen at some point. And I believe this will have huge consequences. It's not, I'm looking forward to the dip. This is something that I would think will create significant civil unrest. It will create a lot of unemployment. I think the banks will collapse and go down. And when it happens, you can come back to this video. And I'm not a crash prophet. I want to make sure everybody understands the consequences of such a significant crash. If you're interested in a video in which I talk about the similarities between the market sentiment of 1929 and now, let me know, because I know there will be people in the comments who say I'm crazy, there won't be a crash like that. But people in 1929 said that as well. In the 1920s, there will never be a correction, it can't happen. Okay, today the Fed, that there's no way, Okay, and I'm happy if I'm wrong, because then at least we can avoid a lot of civil unrest, I'm sure. But I could be wrong. There is a bullish alternative, but what I propose will happen is a crash into the $3,000 region, which would be an A wave, first leg of the correction, then a B wave, which could even overshoot. So people always ask me in the bear market, so where do we put our money? Well, see, if you raise cash, put that aside, that's an asset as well. You could do that. You could look for other asset classes that are not correlated. Reality is, if there is a liquidity crisis, most of these will probably crash together. So that's what happened 2020, mini crash. A lot of asset classes started to correlate. Bitcoin, the Nasdaq, the S&P 500, gold even crashed. And some of them recovered quicker than others, but most likely most asset classes will go down. Now, if you're interested, as I said, to explore other asset classes on this channel, let me also know in the comments. These are sort of the topics I want to dive into, but I think this will be a buyable dip. I think there will be a rally and then a very long and drawn out decline in wave C. I could be wrong about this one. That might never happen. But either way, we will figure that out, because this will be a buyable dip. There will be a rally, and then it makes sense to take profits here. And then we will see where this decline ends. Okay, so we can always let the market tell us what's happening. We don't need to try to predict. There will be levels that we have to watch. And also now, I'm not bearish. Don't get me wrong. I'm cautious. I'm not bearish. It's not the time to short the market. We're still in an uptrend. I would even be on the long side on the smaller time frame, but cautious from a macro point of view. So portfolio-wise, I would be cautious, careful. What that means for you individually, only you and your portfolio can decide. Now, let's take a look at the Dow Jones Index as well. Don't want to talk about that too much, but also here we have this rally. We're close to the end of a major third wave, and there will be this major fourth wave correction. So also here, I could even go to the monthly chart. We're coming close to the end of that major rally. This also goes back to 1932, the low, very similar structure. Wave 1, 2, third wave, close to the end. And again, we're talking about a nearly century long wave 3. The wave 4 will take time. It will be substantial. It is due. I'm not saying it will happen now, I think it could happen this year, but it could very well be that the catalyst might just need to be the right catalyst that hits the market sentiment at exactly the right time, and it's not there yet. All we can do is watch the markets. I would go if I was aggressively trading, I would focus on the smaller time frames, because as a trader you don't care, right? As a trader you really don't care where the prices are. You're just moving your range. If you have large positions, long-term positions, I would cut the risk. That's all I'm saying. I wouldn't be short, but I would cut the risk. That's the Dow Jones. And then I shared with you already in the video a couple of days ago the Bitcoin chart and the Nasdaq chart. I'm not going to go into the Nasdaq chart. You can check that out. It's the video from a couple of days ago. But also here, Bitcoin, you see, I've marked it on this chart long-term top, because this is also a 5-wave rally, not only from the 2022 low. No, it's a 5-wave rally also. And after 5 waves, again, Elliott Wave, after 5 waves, we're looking for a correction of exactly that 5-wave move. Now, we also have a 5-wave move from the 2019 low, and it goes back even further, but there should be also a major correction, which could have major consequences also for Bitcoin. Also here, I could be wrong about it. Maybe there will be a super cycle. I'd be happy about that. Therefore, think about it. I will also trade it as if I'm wrong, because now, while the risk is high here, for me it's always about, I'm thinking differently than many I always see it in the comments. People ask me, is it going up or down? I'm thinking in terms of reward and risk. So from a macro point of view, where we are currently after a 5-wave rally, where a lot of retail traders apparently jumped into tech stocks, and many tech stocks look like Bitcoin's chart. Yeah, whether it's Meta, Facebook, formerly Facebook, or Netflix, they formed 5 waves up from the 2022 low. I believe they will crash together. So where for a lot of retail traders, investors, it's about, is it going up or down? For me, it's more like, is the risk high or not? It's high here. When there is the first crash, it will be low. Why is the risk low? If a crash started, that's when a lot of people are panic selling. Well, because there will likely be a bounce. And when the daily RSI is oversold, that's a tip, then I will buy, regardless of the Elliott Wave pattern, because oversold RSI on the daily for Bitcoin, 9 of 10 cases leads to a nice bounce. You don't even need to call the bottom exactly, right? But yeah, there will be a rally, and it could again lead to new all-time highs, because it could be a B wave, these overshoot before we go down further. But I can be wrong about it. Maybe it's a so-called 1-2 setup and we go up further. Therefore, I will buy here, and I will be careful not to cut positions too quickly. So that's my view. So I just wanted to recreate awareness about tariffs. I wanted to create awareness about the overheated market sentiment in the tech stock sector. There are other asset classes, believe it or not. People ask me in the comments, if the risk is high, what should we invest in? There are many other asset classes, or even there are more stocks than just in the US. Yeah, there are energy assets as well. There are precious metals. I'm even very interested in, for example, palladium and platinum. They are at cycle lows, I believe. So let me know if you want a video about these, but they don't rank very well normally, unfortunately. Don't know. No, many people aren't interested. Why are they not interested? Because we are in a boring phase. People love to buy the stuff that's going up, right? That's high risk for some reason. Again, most people are typically on the wrong side. That's why 90% of traders typically fail. But Elliott Wave helps us to understand that balance of reward and risk. So I hope you liked that update about tariffs and market sentiment, S&P 500, Bitcoin, the Dow Jones. Let me know your suggestions for future videos. Make sure that you subscribe to this channel. I would highly appreciate it. And let me know in the comments, which other asset classes you would like discussed in future videos. Thank you very much. Bye-bye.